Welcome to the REI Education Club at Intel. Today is April Fool's 2022, but we've got a great group of people in here. And first of all, I wanted to point you towards our previous Speakers Hall of Fame page, which does need to be updated. But here you're going to find all the previous speakers that have spoken in the past. Everything from out-of-state investing to short-term rentals, tax deeds, monetary policy, brokers giving their opinions on different areas, real estate CPAs, tax minimization policy strategies. Of course, syndicators. I think our current speaker will probably be talking a little bit about that. Investing in vineyards, outdoor construction, infinite banking, the emotional journey of evicting a tenant, all sorts of great topics here. So be sure to check this page out. The other announcement that I have is that we're switching schedules slightly. For the past 2.5 years, we've been Friday at noon. And actually, according to meetup.intel.com, we've actually run 126 events in the last, since January 1st, 2020. So we are like clockwork every single Friday. But now we're going to be like clockwork every Thursday and Friday. So let me explain this a little bit. We're not doing twice a week. We're alternating weeks. 1 week will be on Thursday, the next will be on Friday. And I think that's going to strike the healthy balance that we were looking for earlier when we were doing 2 events per week. So the Thursday event is going to be a getting together event with other REI clubs. The REI club from Walmart and Apple and Amazon and a few others are going to be coming to that particular event. So we'll all come together on a bi-monthly basis, twice a month, and then we'll all be separate in our own clubs twice a month. So for weeks 2 and 4, we'll be here on Friday at noon, and for weeks 1 and 3, I believe that's how it is, next week we're on Thursday. So be prepared for that. I will send out calendar invites to make sure that everybody knows when they are, and I hope you could make it. All right. Also, check out the SharePoint site. We've got our site here. We also, I talked to Glenn a little bit earlier. Thank you so much for your help. But he helped me figure out what was going on with Microsoft Teams. And I don't know that this is what was happening, but in previous meetings, when I put the link to Microsoft Teams in here, we were getting a lot of people joining the Microsoft Teams channel, which hopefully will be a lot more active than the Yammer channel. But I think there's an administrator somewhere who's deleting the people as they come in, because I would admit, 20, 30 people, and the next day there'd be nobody in the group. But like the member roster would be zeroed out. So I don't know exactly what's going on there. But we found a different way of adding people that might work. I'm going to, in the middle of this meeting here, drop in the code. And what you need to do is you need to come down to, maybe I won't show my Teams, but you need to go down to Teams. I'll put a little video together with how to do it. Go down to create or join a club or a team. And then the first option will be join by code. And I'm going to drop the code into the chat here in just a moment. And so without further ado, I want to welcome Anna Kelly. Anna, Great. Welcome to the Intel Club.
Thank you so much for having me. It's my honor to be your guest today. I am new to Microsoft Teams, believe it or not. So I left the corporate world when I retired from AIG about 3 years ago. And so I'm much more used to Zoom. So I'm going to attempt to share my screen and show my slides. And if that doesn't work, Daniel, you have my slide presentation, correct?
I will verify that. Just a moment.
Okay.
Yes, I do.
Okay, let me just click share here and make sure that this is coming up. Are y'all able to see my screen?
Yes.
Okay, so you can see these slides.
Yes.
Okay.
Well,
wonderful.
We see all of PowerPoint. We see the menu up above and the slide previews on the side.
Okay. So, and I apologize. I know a lot about investing and a lot about real estate, but I do not know about Microsoft Teams. So I'm trying to get back to where I can see you. Okay, now that I'm looking at the screen, can you still see my slides or no?
We only see you now.
Okay. Um, so I tell you what, I'm going to go ahead and just start talking and I'll share my screen. Daniel, if for some reason you can't see it, once I start sharing, just stop me
Okay.
and I'll be happy to pause. But what I thought I would talk about with you guys, I know that you have a broad range of experience in investing in general and investing in real estate. And like Daniel mentioned, I posted a lot about the economy and what's happening. I have a background in the investment arena. For 25 years, I worked with ultra high net worth investors. And so I've seen every type of investment from retail mutual funds to very expensive, risky offshore hedge funds to real estate investing. And so wherever you are in your investing journey, I'm hopeful that what I talk about today will help you. And what I want to do is talk to you a little bit about market cycles and how market cycles impact you as an investor and how they will impact you in your real estate investing as well as investing in traditional real estate. So I'm going to.
Hey, Anna, I just shared my screen with your slides up. And so if you want, you can continue to have, your video up and I'll share the slides.
Wonderful.
Or we could just,
Great.
have you share the slides however you'd like to do it.
Yeah, I think this will work really well. So I'll just tell
Okay.
you next slide and that'll
then,
be great.
all right. And one other thing, if you have questions for Ann, go ahead and put them in the chat section. And Ann, you don't need to worry about reading those off. I will keep track of them for you and judiciously interrupt you with the questions.
Sounds wonderful. Probably what I'll do, Daniel, is get through the presentation and then leave room for questions at the end, because a lot of the questions that are going to come up may be answered later on in the presentation. I have a lot to share. I talk quickly, so I will do my best to get through this in the time allotted. But I want to talk to you about economic cycles and the factors that can impact your markets if you're investing in real estate and your success as an investor overall. And essentially what we need to understand as investors is that economies go in cycles. They go in cycles of expansion or growth and contraction or decline. And typically in an average cycle, we're dealing with 4 different peaks or troughs of a cycle. We start at the bottom at recession. That's when the economy is really bad. And most recessions historically have lasted about 18 to 24 months, and then you move into recovery. More recent recessions have been less painful, less long. But at any rate, we go from recession, we start to recover, we start to have economic activity and spending again, and that recovery leads to growth. Growth leads to a point where there's so much activity, so much spending, so much rise in prices that eventually we get into a hyper supply mode where there's more supply of most goods and services or real estate if you're a real estate investor than there is demand. And that generally leads back down to recession. And I'll show you some pictures and some graphs here of what that looks like. But what's important to know is that a lot of times when you listen to economists, they speak with a very broad brush. And so they'll say supply and demand is here, and therefore we're going to grow or we're going to collapse. Real estate's going to keep going up in values or real estate's going to crash. Same with the stock market. And the reality is that the longer I've invested, the more I understand that so many different things impact market cycles and where we go, how quickly and how long they last. Employment growth, building costs and prices, inflation, interest rates, trade policies, tax policies, political environment, and legislation can all impact the national economy, but also impact local economies and also impact real estate. And I'm going to show you how here in a second. You can go to the next slide. So as of January 2020, before COVID hit, we were in or very close to a hyper supply market, meaning everything was at the top, asset values, prices, etc., especially in real estate nationwide. We were in the longest expansion or growth period since Abraham Lincoln was in office. And I know that sounds like a really long time, but essentially we had 11 years of growth after the Great Recession, and we were continuing to grow. So many economists said we're due for a correction and a contraction, basically coming back down to recession. It wasn't not a matter of if, but really when it would happen. And while we hit a quick minor recession in 2019, things seemed to be starting to get a little bit better. There were fears of recession, and then COVID hit, and that really pushed us over the economic cliff, if you will. And the government had to react very, very quickly and in an unprecedented way. So, to stop us from going into extremely deep recession, what the Federal Reserve did, and the Treasury and the US Congress, was make sure that we could continue to borrow cheaply. And they gave us a lot of free money, whether you're an individual investor who got money in your checking account, whether you have a small business on the side, or whether you were a corporation. There was a lot of free money, and importantly, very, very cheap money available to borrow to continue to hopefully stimulate the economy, not to go into deep recession, but to keep spending. And what this did is it created artificial demand and much more expendable income for investors, for individuals, and for companies. Having artificial demand, continuing to spend, feeling like the money was just going to continue to flow, has led to massive price inflation, as we've seen in the news every day, and also to massive asset inflation, both of which on their own can lead to corrections. So COVID and this artificial demand also led to supply chain issues, and supply chain being bottlenecked from exports as well as imports, as well as just not having enough supply to keep up with the demand. So the Federal Reserve, as you see in the news all over the place, now must reasonably try to squash demand without putting us over the edge into a deep recession. And the way that they do that is they significantly raise interest rates, the Fed funding rate, which I'm happy to talk about during the Q&A. But all of this to say, where we are in the economy today, I suspect that we're heading for recession. There's a lot of different signs of that, which we can talk about. And one of the most accurate predictors of a recession is the yield curve predictor, which is basically the spread between the 2-year Treasury and a 10-year Treasury. And when people will pay more for a short-term Treasury than a long-term Treasury, it has been pretty accurate at predicting a recession is on the horizon in the next year. So economies change. We cannot predict when. It's really difficult to time the market accurately and specifically, but we can see signs that help us to plan and invest for the best possible outcomes through these changes in the cycle. Daniel, you can go to the next slide. Okay, so market cycles are essentially measures of aggregate economic activity. It's a combination of our gross domestic product or production, employment, income, and sales. Cycles are defined by periods of expansion and contraction, recovery and recession. And expansions and recoveries, generally speaking, are marked by rising output, more jobs, rising incomes, and increasing sales. And they kind of continue to feed off of each other. Contractions and recessions are defined as falling production, falling employment, falling income, and falling sales. Recessions are really hard to accurately know that you're in the middle of because they are not technically called until you have already cleared 2 consecutive quarters of a reduction in real GDP. But the Fed can alter and tries to alter when we go into recession, how deep and how diffuse. And generally speaking, you find out we've been in a recession about 8 months after it started. Recessions are serious and they lead to a vicious cycle. They vary in depth, duration, and diffusion across industries and geography. And what I mean by that is sometimes you'll see recessions that really hit a certain sector really hard. So the recession in the late 1970s, early 80s hit real estate. In 2000, we had a tech bubble. In 2008, we had a real estate bubble and financial system bubble. And right now, there are many very wise investors and economists who say we are in an everything bubble. And if we hit a recession this next time, it could be very diffuse and impact a lot of different industries and investments. You can click the next slide. Okay, so understanding how economic cycles impact you as an investor and lending decisions for loans to purchase different types of investments is really important for you to understand when it's time to buy and sell and what you should be buying to meet your financial goals and with a view to what's coming. In some cycles, lending is very, very tight. In others, it's really easy to get money, but it's really hard to find deals like today. When things change, that reverses and it's really easy to find deals and it's really hard to get money. In some cycles, there's more housing supply and demand, and it's harder for sellers to find buyers and there are low prices. That's what we typically see in recession and recovery. In other cycles like today, there's going to be more housing demand than supply, and sellers can name their price. And there's multiple offers that drive prices upward, and it seems very, very difficult to find good deals. In some cycles, prices are going to rise, and in others, they're going to fall. But in all cycles, something that's important to real estate to understand if you invest in real estate, that whether CDs and treasuries are low or high will impact what you as an investor are going to pay for real estate, because the difference in what you can yield investing in a CD or a treasury and what you can yield for taking on additional risk of investing in real estate is called a risk premium. And that risk premium is going to be different and higher. The higher treasuries go, the more return you're going to demand to invest in real estate. So as you start to see rates going up and treasuries having higher yields, you'll start to see investments that rely on any higher risk than that demand a higher yield, and therefore pricing will start to come down. And that's really important to understand. Okay, so now we're going to look at kind of a picture of what an economic cycle looks like from a real estate perspective, if you want to click the next slide. So you'll see I'm going to start in stage 4. So stage 4 is recession, where demand is really low. Defaults tend to soar because people lose jobs. Companies start to default on debt. They start to lay people off. There's less demand for products, so prices come down, and therefore companies start to make cuts in their employees and in wages. At this time during recession is the time when we can buy properties for rock bottom prices. So while everybody else is afraid, they're very motivated to sell. It's a really good time to go against the stream and continue to invest, even though everybody else says that real estate is bad at that time. Then you move into the next stage, which is recovery. And during recovery, the demand for housing is still fairly low compared to other times. You typically have higher vacancy rates because when people struggle to pay their bills, they struggle with high gas prices, they struggle with wages, they're more likely to find a roommate, to move back in with family, and you tend to have higher vacancy rates. This is the time to continue to buy properties or to refinance them, because when you're in a recovery stage, interest rates tend to be lower as well. Then when the economy starts to be stimulated, the government puts in cheap money again, low interest rates again to get us out of the recovery. That's the time that the economy starts to recover and expand. And new construction starts begin all over the country. Low interest rates persist. It's a good time to refinance again properties and invest in new development, or invest in things that you believe are going to have growth through the expansion period. And at the top, we finally get to a point where we have hypersupply in the system, which we talked about is an abundance of inventory. Construction and real estate starts to slow because you have too much supply. And it's a time to sell when you think you're at the top, or to buy a really stable asset that you think will weather a recession and an economic storm if and when we dip back into recession. And these cycles happen over and over and over in the economy, and over and over and over in real estate. The big question is, how long will they last? How high and how low will they go? And that's where we learn about these different trends to help us to make decisions on what's going to happen. You can go to slide 7. Okay, so this is very similar, just a different graphic of what happens during a recovery, expansion, hypersupply, and recession. Generally speaking, during recession, you are in a buyer's market, and that means that there are motivated sellers. There are many more people trying to dump properties than there are trying to buy them, and therefore it's easier to buy them as a buyer for a really good price. When you come out of recession into recovery, it starts to slightly become a seller's market. A little of the nerves go away. Sellers are thinking things are getting better and they want to kind of name their price. During expansion up until hypersupply, it's generally a seller's market. It's hard to find really great low price deals and feel like you're stealing property. And then once you hit hypersupply and things start to come down, it switches again into a buyer's market. And this is typically how real estate works. We are in a very odd period where while we hit hypersupply across a lot of the country, we've kind of gone backwards as COVID has stimulated more demand than there is supply. And while we might be in a little bit of an expansionary mode in real estate, the economy overall is definitely headed down toward recession as inflation skyrockets. And the question is, can the Fed keep us in this hypersupply section or box, if you will, on the graph? Or are they going to tip us into recession if they raise interest rates too high? But I would say we're somewhere between probably the yellow dot in recession and the black dot in hypersupply, if I had to guess. Okay, you can go to the next slide. So this is a very similar graph, but it talks a little bit about what happens to credit when you're dealing with real estate. So for those of you that invest in real estate, specifically, during the expansion period, when things are growing, interest rates stay relatively low. And again, that's because the Fed is wanting to see more stimulation in the economy and more growth. And they keep interest rates low in order to do that. Basically, anyone with a pulse can borrow at this place. And credit defaults are very, very low because rates are so low and prices continue to go up that most people that get in a bind will just sell their property or refinance. Then when you hit a downturn, interest rates start to rise. Lending gets very, very tight. And there's a lot of lenders that are already tightening criteria because they see pain ahead. And credit defaults start to rise because prices start to come down, interest rates go up, people can't sell or refi. And then eventually you go into your downturn. And then during recovery, interest rates peak, they go to the top. Lending is really, really challenging. Credit defaults peak. And I saw this in 2008 and 2009 during the Great Recession. It was really easy to find cheap properties, but it was really, really difficult to get loans, especially for someone like me who worked for AIG at the time of the Great Recession. And then slowly but surely, during the recovery, interest rates will start to get cut by the Fed. Lenders are cautious. The Fed will encourage them to lend and credit defaults start to decline. And then we go right back in that cycle. So just understand that if we do start heading into recessionary territory and prices start to come down, it'll be easier for you to find properties, but it's going to be much harder for you to finance them. Okay, we're going to go to the next slide. I love this graphic. I wish I could take credit for creating it. I did not, and I do not remember where I found it. So I will give credit to someone else, not me, but it's a great graphic. And essentially, what I want you to understand is that as an investor, whether you're investing in the stock market or whether you're investing in real estate or anything in between, you are going to go through a cycle of market emotions. When things are going really well, and let's say 2009, we came out of depression, we started to see stocks go up, real estate go up, just about everything go up. You're optimistic, you get excited. And then as you make a lot of money in really great growth stocks and real estate, you are thrilled. And you have this deep euphoria of what can I buy next? You're just so excited. You think that you absolutely cannot lose. Things are just going great. At that point, when you see that throughout the economy, that is the point of maximum financial risk. At the point that everybody is really excited, everybody is greedy, Warren Buffett said that's the time for all of you to get fearful because things are going to change. Once things start to change, kind of like they are now, people start to get anxious. People say things like the yield curve is showing us that we're going to go into a recession. And others are saying, there's no way, this time it's different. Things are going to be okay. This time it's different. Then you start to see some of your stock picks and some of your real estate not doing so well. And you think, oh, this is just a temporary setback. Then as the knife starts to fall, we get fearful. We lose money. We get despondent. The markets panic. And we get to the bottom. and have a sense of hopelessness. I wish I had never invested in real estate. A lot of people felt like that in 2008 and 2009. When everybody is hopeless and everybody is afraid, that is the maximum point of financial opportunity. And that's the time when everybody is fearful for us to start getting greedy, in a wise kind of way, right? We go from depression, and then once things start to get a little better, we think, okay, maybe the worst is over. We have hope, we have relief, and then we're back to optimism and life is good. And this will happen to each of you as an investor as we experience the highs of the economy and the lows of the economy. And just know that if things get bad, as I suspect they may in the next year or two, through recession, don't let your hopelessness pull you out of the market and say, I'm done, I'm not investing, this is too hard. That's the point when you go all in. And for me personally, just as an aside, in 2009, I lost just about everything. I worked for AIG. I was heavily invested in financial stocks, most of which never came back. Lost about 2/3 of my 401k during that time. My real estate's the only thing that did well. I was in probably the worst hopelessness and depression financially that I had ever been. And it was really the grit and the resilience to say, I'm not going to give up. I'm going to keep investing, that really completely changed my life, created millions of dollars in real estate for me, and allowed me to enjoy the lifestyle that I have now at the peak. So when you get to that point, don't stop investing, just invest wisely. Okay, next slide. So when it comes to real estate, in a recession, again, the sentiment is going to be panic and hopelessness and fear. It's going to be a buyer's market if you are in real estate. Lending will be very tight. You're going to have higher interest rates for a while, and the prices are going to be low and start growing over time. It's a great time to buy. And if you can't get financing, it's a time to start learning about creative financing. And creative financing is what allowed me to continue to move forward and buy when the bank said no. Recovery, you're going to feel some hope and relief. It's going to be kind of an equilibrium of a market, turning into a seller's market over time. Interest rates will be cut again to help with the recovery. Lenders are going to be nervous, and it's a great time to buy, but it's a great time to buy with seller financing. Next slide. So during expansion, things are optimistic again. There's excitement again. It becomes a seller's market, high prices, high demand, unmotivated sellers, and lending starts to loosen. Rates start to come down to encourage you to continue to buy. Prices are near the top and they'll grow for a short time before peaking. It's a really good time to buy if rates are really low, or if you decide that you're at the top, it's the time to really think about selling. When you do hit peak or hypersupply, you are in euphoria and greed. Again, this is the maximum point of risk. And I would argue that through all I've seen in 22 years of investing, this is probably the most euphoric and greedy I've seen the economy since 2007, when I took way too much risk, not having any idea that the economy was about to return. It is a seller's market that starts to turn to a buyer's market as supply starts to outpace demand. Lending, interest rates start to rise. Lenders become more cautious. Prices will peak, and it is the time to sell anything that you don't think will weather a recession, or just to cash out your equity in order to have money, or dry powder, as we say, to be able to buy when the economy turns. Okay, next slide. Okay, so one of the things to keep in mind is we all have plans. We have financial plans, we have plans for our properties, plans for our investments in the stock market. And because of changes in the economic cycle, we may have to make a decision to hold our holdings, our investments, or our properties longer or shorter than we had originally planned. I've sold a lot of properties when prices were high. And in fact, I've recently sold a lot of properties in the last year and a half. And I've also bought a lot of properties when prices are high, but when rates are really low, which is exactly what the government wants investors like us to continue to buy with high prices because of low rates. In recessions, you have to realize that things are starting to get painful, and you have to be able to see that we're heading into a recession to make sure that you're well capitalized and that you have reserves. This is really hard to do when inflation is 7.5 to 10% like it is now. I've gotten very liquid. I just sold in the last 2 weeks 5 different properties. And it's hard to sit on cash and think it's being eaten away by inflation. But when you start to head into economic times and that are challenging, it's really important that you have dry powder, not only to be able to invest when prices come down, but to be able to weather any kind of economic storms of your tenants not being able to pay, loan interest rates going up, and you having to put in some equity to pay down those mortgages to keep your debt coverage where it needs to be. So in recessions, I saw this in 2009, banks start to call lines of credit. Banks start to shut down credit cards, and commercial loans that do not maintain their minimum debt coverage ratio that the lender requires start to have the risk of default. This is a big risk in the commercial loan space right now for both corporate debt. Have short-term debt. It's wise to start to think about refinancing those things, getting your rates locked in at a lower rate. And if you have lines of credit, you might want to actually term them out. Take from them, set them aside on a checking account, lock in the rate, because if you don't use it, it's very likely that the banks will start to call it when we hit a recession, and then that access to that capital to invest will be gone. Okay, next slide. Okay, so weathering different cycles, especially a recession, you always want to have multiple hold strategies and multiple exit strategies. And it's one of the things I love about real estate is that it's very malleable. And in good times and bad, I can change strategies to help me to continue to do well. In the pandemic, during COVID, I had almost 900 units of apartment rentals. And it was really important that I had a lot of cash. It allowed me to be very compassionate with my tenants that were struggling. But I also started accepting Section 8 housing in some of my complexes where I didn't before, because the government basically guarantees that they'll pay those rents. So, be malleable in the type of tenants that you allow. I also had some short-term rentals in my long-term rental properties. So while vacancies were up, we did short-term rents in some of our properties, and that allowed us to continue to cash flow. And if people stop traveling and visiting your short-term rentals, maybe you put a long-term tenant in there. So just have multiple strategies for continuing to make your debt payments in a recession. You want to choose debt very wisely depending on where we are in the cycle. And I cannot articulate this well enough. If you think we're heading into a recession, you do not want to invest in any properties alone or as a passive investor where they have bridge debt on the property that they will have to refinance out of at higher rates in the next year, 2 or 3 years. I suggest that if you are getting loans and you want to maximize your cash flow and you can get them, get 2 or 3 years of interest-only payments on a longer-term loan with a 5 or 6 year fixed rate period. It can allow you to have some extra cash flow that you'll then set aside to be able to weather some economic storms. If you can get it, 30-year fixed debt is ideal because you remove interest rate risk, and you want longer amortization periods instead of shorter. That goes against what some people teach, but again, you need to maximize income on rental properties, and so you want a longer amortization period with a shorter, smaller payment. And then I'm also going to suggest that you evaluate deals and rent growth projections with a view to the next 5 to 10 years. A lot of you may have seen, operated, or invested in growth value add multifamily real estate, which is what I do a lot of, right? During a growing economy, it's really easy to create growth on the back end in multifamily with big value add deals or repositions. When you're at the top and coming down, it's not real wise to have short-term investment periods like 2 to 3 years, hoping you're going to get the same kind of growth and appreciation and then selling. You're going to need to start rethinking IRR. We often think that IRR is the holy grail of investing. And because the time value of money makes money in the future worth less than today, a lot of investors try to convince you that you need to sell and reinvest the proceeds every 2 to 3 years to churn your money. During a recession, you really don't want to do that because it causes you to take too much risk chasing that IRR. I'd rather see you have an investment that can weather an economic storm over the next 5 to 10 years, focusing on your average annualized return instead. Okay, next slide. Okay, so you want to build a diversified portfolio, and I'm sure you've heard this most of your investing lives, whether you're in the stock market or anything else. Do not put all of your investments in a single company, in a single stock, in a single investment property, in a single location. If you can invest in multiple markets and multiple locations, some of them will weather a recession better than others. I invest in Pennsylvania, in Atlanta, Georgia, in Houston, Texas, other parts of Texas, Florida, Tennessee. One of those areas may get hit hard in a recession. The others will probably help counteract that. And so do deals that offset risk. You also don't want to be all in one asset class. So I love multifamily, but I have a lot of single family homes. I have a lot of short-term luxury vacation rentals. I have some self-storage units. So spread your investments across multiple asset classes in multiple markets. And the other thing is just remember your financial goals. First, buy for whatever your primary financial goal is. Don't buy for what everybody else says is a good deal. You need to make sure that if you're looking to add some additional income, that you're generally investing in cash flowing real estate and not things for growth. But during recessions and during economies that struggle, your financial goals may slow down. You may not have as much growth without a level of risk that you may not want to take, and you may not have as much cash flow. During a recession, asset preservation becomes most people's top priority during a recessionary cycle. Warren Buffett's rule number one is never lose money. One of the ways that you do that is you focus on asset preservation at the maximum point of the cycle when everybody's greedy, and don't take risk. Again, be patient, be fearful when others are greedy, and greedy when others are fearful. Watch other factors that impact the economy. This is something that's so important, because if you're just looking at interest rates and you're just looking at market cycles alone, thinking that whatever the Fed does, that's what's going to make the economy continue to grow or to go in recession, there's a lot of other factors that impact where the market cycle is and how deep it is. High government debt, low GDP, internal conflict, political conflict, external wars, all of those things have a significant impact on the economy. And so it's important to become a student of the economy. In 2007, I had been a private banker for Bank of America. I learned a lot about investing, and I told a lot of wealthy people how to invest their money. I worked at AIG. We put together sophisticated hedge fund investments for the ultra high net worth individuals, corporations, and banks. I thought I knew a lot about investing, and yet I was completely blindsided by the Great Recession and almost lost everything because of it. And the one thing I learned about that is that no matter how much you know about any particular asset class or investing, there's more that you have to learn. And it's those things that you don't understand that can blindside you. So become a student of the economy. Start to study what factors of the Federal Reserve monetary policy impact corporate debt and stock values and commercial loans, et cetera. And how can some of these conflicts that we're seeing today play out, such as the war with Russia and Ukraine, impact our American economy today? Seek the wisdom of others and don't go it alone. That's something that I wish I had done a lot earlier. And then I think we have one more slide, Daniel. Okay. And then I just want to shift gears a little bit to specifically to real estate, because that's mostly what I do now. For recession resilient investing, you need to start thinking about, if you agree with me and think we're heading into a recession in the near or not so near future, maybe next year or two, you might want to start thinking about what investments are going to weather a recession the best. When it comes to real estate, multifamily housing, apartment buildings have been the most recession resilient asset class historically. There's a small pocket of self-storage that did better in the Great Recession, but generally speaking, multifamily housing is very recession resilient if you invest in the right assets and the right locations. What happens is when the stock market starts to rumble, when the economy starts to flounder, a lot of big institutional money flees the stock market and they move into multifamily housing as a preservation of capital play. Of course, that raises prices, but it comes with preservation of capital. Rule number one, never lose money. And you get some income during the hold period to weather the economic storm, and you get big tax benefits. And those tax benefits right now are very, very, very lucrative. It's also easier to predict and control many factors that impact the values of multifamily than you can control and predict the factors that impact many other investments. Remember that people always need a place to live, and those that hit hardest in the recession are usually Class A renters, meaning those that can afford the most expensive apartment rents with really great amenities. When I lived in Houston, we had concierge dog walking, we had valet parking, we had concierge dry cleaning, all kinds of things. When people start to lose jobs, they often cut middle management who makes really good money, and then they will start to move out of those really expensive apartments with all those amenities, settle for less, but want to stay in the nice markets. Class C, average workforce housing, tends to be really hit hard in a recession. And so my sweet spot is investing in an older Class C building in a growing Class B area. So a really nice market, a really nice area. Think nice shops, good restaurants, Starbucks, and just a little older building with less amenities, because the people that have to downgrade will move there, and the Class B worker tends to keep their jobs the longest. I also want you to consider, regardless of your own personal politics, investing your investment dollars in communities with a conservative local government, because what happens is they keep taxes lower and there are no rent up, and you can't keep up with rents to cover them, you could lose your properties. In all economies, Class B areas tend to fare the best with stable jobs, stable schools, nice neighborhoods, and people will be willing to pay more to be able to stay in their community. When high income earners can't afford Class A areas, they move down to Class B. And also just remember, you don't want to buy the nicest property in a rough area. You want to buy a rougher property in a really, really nice area, and then go in and change that property to bring it up to standards. And that's where we tend to do best, is when we have a balance of properties that'll preserve our capital. They're not likely to go down in value. They'll continue to have cash paying residents and tenants. They'll give us that tax benefit. And then when the economy comes back, they'll start to grow and go up in value just like they did before. And with that, there's just my title slide, Daniel, with my company name on my website if people want to be able to get a hold of me. And that's the end of the presentation, and I'm happy to answer questions.
All right, we have a ton of great questions here. But first of all, Alex is asking, hi, Anna, would you recommend purchasing land in this market cycle to build a primary property? We own, but eventually want to get into something bigger, or can purchase an investment since it will take years for builders to catch up to inventory. What are your thoughts?
Yeah, this is a really great question. And I'm going to tell you what I tell everybody, and that's truly it depends. It depends on you and what your financial goals are. So if you're somebody that has time on your side and you're willing to wait for the value of that property to go up, you're willing to wait for construction prices to hopefully come down, some of these supply chain bottlenecks to slow down, and interest rates to come back down once they go up, which they're going to do. I'd bet a lot of money on it. If you have time on your side and you can set that money aside and not hurt without it, then buying land is generally always a good idea if it's in a really strong market, because land prices, generally speaking, tend to continue to go up as long as there's good jobs around. But if your goals are income, for example, and you say, you know, I really need to, maybe you're about to have children and you say, I'd like one of us to stay home with those kids. You need an extra $3,000, $4,000, $5,000 a month coming in. You're not going to want to buy land that's not going to pay the mortgage and pay the cash flow. You're better off investing in something that produces that income and that cash flow for you passively than taking that income that you're creating passively and using it as a down payment on land in the future.
All right. Ashish is asking a question, and you may have answered it in your last slide, but you can also expand on it as well. Anna, can you recommend an asset class or a bear fund that would benefit in a recession? Anything specific to real estate?
Really primarily multifamily housing. And it doesn't have to be, when I say multifamily for the purposes of this discussion, it doesn't have to be a 100-unit apartment building. It could be a 4-unit apartment building. But typically speaking, in a recession, because people are hurting financially, they can't afford a lot of expendable resources. So they may stop purchasing clothing, purchasing vehicles, etc., but they need a place to stay. And so they're going to prioritize where they spend their money in housing. And so typically in a recession, especially if you're in an area with low supply and very high demand, you are going to stay full. Your rents are going to continue to keep up with inflation. If you have to unfortunately evict them, you're going to have 10 people behind them waiting for housing. And so investing in multifamily or apartment, even residential single family houses in areas that are recession resilient is generally going to be the safest place for you to put money. And when I say recession resilient areas, what I mean are areas that have a lot of diverse industry. So for example, I live in the Hershey, Pennsylvania area. I used to live in Houston, Texas. There's manufacturing, there's hospitals, financial institutions, warehouses, you name it, a lot of industries, with one industry or one major employer having no more than about 10% of the employment in that area. When you have a lot of diverse employers, you've got great schools, very low crime, and a strong hospital system. Those areas tend to be extremely recession resilient. So buying any kind of residential real estate that provides housing, whether it's residential or commercial, housing for people that live in those areas are going to weather an economic storm historically better than just about any other real estate you can buy and just about any other stocks that you can buy as well.
Okay, and we are at a 10-minute or 9-minute warning here until the call ends, just to put the alert out there. Eugenio is asking, what were the learnings from the 80s real estate crash? Or do you have any learnings from that?
Sure. I could talk for another hour or two, right, on the things that I've learned about the 80s. But essentially, a key quick takeaway is that the 70s were a period where the government offered very, very cheap debt to incentivize land and oil investors to continue to buy more. And it created a strong rising values of both oil and land. And when that happened, oil and land became the collateral for most loans. Because high demand started spiking prices, we had mass inflation in the 1970s, both CPI, consumer price index inflation, as well as asset inflation. And what happened was when we hit a deep recession in the 80s, because most collateral was on land and oil, when the value of land and oil came down, interest rates went up. And those loans on that oil and land came due at a much higher interest rate. It tipped us into recession, and it caused the crash of real estate in the 80s, as well as the savings and loan crisis, which over 16 banks were shut down in the 80s because of all of the debt they had issued on their balance sheet for assets that were quickly decreasing in value. So I see that similar risk today, although there's many complex factors in where we are today. If we truly are in an asset bubble that's been propped up by cheap debt, corporate debt, commercial real estate debt, and free money, and the interest rates go up enough to make it very difficult to refinance loans and continue to cover that debt, asset prices in real estate and in many corporate stocks could come down significantly. So I'm watching it with great interest. But cheap debt for a very long time and a massive rise in asset values typically leads to a peak that causes asset prices to correct or crash depending on how bad they get. So I'm watching that.
All right, Z Yang has a great question here, and he even included a chart in the chat. But his question is, why do we think that we are in hypersupply if our construction in the last 10 years has been lagging historical construction levels?
Yes, this is a great question. And listen, economies change very quickly, and COVID disrupted the cycle in a way that many of us didn't see coming. And the behavior of real estate is very different this time than what it has been in historic cycles. So generally speaking, real estate is very regional, and a lot of the data that we see on real estate is national. And so nationally, we are undersupplied for housing. A lot of major cities were actually teetering on hypersupply before COVID hit. But because COVID hit, a lot of people ended up not moving. But after COVID hit, and a lot of people had extra money, a lot of regulations happened. We saw a mass exodus out of California, out of New York, New Jersey, Connecticut, Massachusetts, and into southern states. And so in a lot of these states and specific big cities in these states, in the Northeast states and in California, there is suddenly hypersupply because many people have left to move south. In the South, there is suddenly, even though cities were teetering on hypersupply, suddenly there's so much new demand coming in that there isn't enough supply. And so you really have to look at real estate markets very, very specific to the supply and the demand in the markets that you're investing in. Yes, generally speaking, housing is in a state of undersupply across the entire country, but many major markets are actually oversupplied or very close compared to the demand.
All right, Henry is asking, so would you recommend now to exit investments and go into cash and wait for the next financial opportunity, or are things you recommend? Are there things you recommend?
Yes. Again, this is it's a very hard answer to question to answer with just a blank slate that works for everybody. If you do not have a lot of extra investable capital and a recession comes, your primary goal needs to be able to sustain your family if one or two of you, if you're a two-income earner, loses a job. And so having some liquidity is more important than staying in the market and things that have a high likelihood of volatility, things like stocks, things like certain types of real estate as well. So if you don't have 6 months to a year of expenses set aside and saved, then I would recommend that you get liquid no matter who you are, at least for that amount. Beyond that, it really comes down to your risk tolerance and your time horizon. During recessionary periods or close, you have to be very patient and more risk averse, kind of more of a curmudgeon, a little more pessimistic about the immediate economy in the next couple of years. And if you're not very liquid and you don't think you can weather 2 years of really hard times, you probably should sell something to have some liquidity. The balance to that, though, is that we are in extreme, largest in my lifetime, I'm 47, consumer price index inflation. And so if inflation isn't gotten a hold of with Fed rate increases in the next year or two, costs could really go up. And so every dollar you have in cash sitting there is being eaten away by inflation. So you have to figure out your risk tolerance and your time horizon to come up with a level of liquidity that makes you comfortable. With that said, I would for myself, my comfort level has been 20% of my net worth completely liquid and ready to invest when hard times hit, ready to be able to cover mortgage payments if my tenants can't pay, and weather an economic storm.
Great. You answered several people's questions in the list here already with that last statement. Here's a slightly different question, and we are at a 3-minute mark right now until the end of the meeting. How do you manage properties in multiple states? This is by Justin.
Great. I partner with really great property management companies, the best of the best in those locations. Managing from a different state in some ways is easier because I don't have to be the one that's there answering the calls, tenants tracking me down, trying to get me to react to everything. So managing from different states just really requires you to get really good at the numbers, understanding the business plan and the finances, and then relying on experts to continue to manage that property in a way that's going to execute your business plan.
All right. This is an involved question, but Druvol is asking, how would it impact economic cycles if most people prepared for an economic recession and raised as much cash as they could get into in the last few years? In other words, it's much easier to learn to have access to data in the past, so investors would be more proactive and prepared. So how would it impact the normal economic cycle?
That's a very deep question. There's a lot of economists who think that we kind of move into the self-fulfilling prophecy, that if people think there's a recession coming, everybody starts to panic at once, and then that causes a recession. So to the extent that education minimizes panic, you probably can delay the level of panic and the speed of panic once it starts if people were more educated, I would say. But the reality is a lot of the things that happen in economics and in market cycles are really driven by, and I'm not a conspiracy theorist, I'm not blaming the Fed on everything, right? But federal monetary policy and congressional fiscal policy really have a lot to do with the highs and lows of the economy, the cost of borrowing, the cost of investing, having cheap debt and free money always leads to growth. And at some point, it always leads to a tippy top where the growth just isn't sustainable anymore. And you get hyper supply and it comes back down. So, we have not found a way to stop that cycle yet in American history. The question is there enough knowledge and education and consistency of the factors that impact the economy such that the Fed can figure out how to prevent great crashes and keep things more stable? And because of how complex things are, internal conflict, external conflict, how intertwined we are economically with other nations, all of those things really impact the economy in really complicated ways that most economists don't understand, admittedly don't understand, that become more and more complex, not less. So I'm not sure how you get rid of recessions coming. I just know that you got to educate yourself a lot to see when the signs are there that they are coming, and then make better decisions so that you're not stuck holding the bag when it happens.
All right. And really quickly, the bonus question, where can we find you on social media?
Great. You can find me on Facebook, LinkedIn, and Instagram at Anna Kelly, REI Mom.
And everybody on the call, can you take yourselves off mute and thank Anna for presenting to us today?
Thank you.
Thank you, John.
Thank you.
Thanks, Anna. Really appreciate it.
Thank you.
Thank you so much.
Thank you very much.
Yeah, thank you very much. I put your Facebook link into the chat for people that want to find it there. Hadn't quite got around to your other social media accounts, but we'll include them on the Speakers Hall of Fame for people that are looking for them as well.
Wonderful. And, thank you so much for having me.
Thank you, Anna.
Yes, you're welcome.